Now on to our top story today. RBI's recently announced guidelines on first loss default guarantee or FLDG in digital lending have brought in some much needed regulatory sanctity and removed ambiguity around its use by banks, NBFCs and more importantly non-NBFC fintechs. However, RBI has tightened norms on the extent and form of the FLDG cover and recognition of non-performing assets in partnership models. These include limiting FLDG to 5% of the portfolio and not allowing corporate guarantees as a form of FLDG. So joining us now to discuss this and its implications are Ashish Goel, who's the director at Fintech Association for Consumer Protection, or FACE, and the co-founder of Five. Also joining me is Anand Kumar Bajaj, the founder CEO of Pay Nearby. Ashish and Anand, both of you, thank you very much for your time here on CNBC TV 18. And Ashish, I'm going to start with you because, this brings in some much needed legitimacy, even if with some stringent rules. What's been the general feedback from fintechs, areas of worry and areas of relief?
I think it's a very, very good move by RBI, purely from a perspective that it brought a much needed clarity to the entire ecosystem. It is the best thing which has happened to fintech for a long time. And in my view, this brings clarity and much more needed support relief for the fintechs. I think the biggest beneficiary here would be the borrowers which borrows from the fintech, because it will bring more capital to the fintech industry as a whole, as well as it will reduce the cost of funding for the borrowers who are the ultimate consumers. Overall, it is a very, very great step by RBI.
Sure. Anand, if I were to come to you and get into more specifics, to what extent had this lack of clarity on FLDG affected lending overall, and now will there be a significant boost? Or, are there any terms in the latest guidelines that fintechs like you are worried about?
Sorry, the whole machinery was almost on a standby and awaiting the regulatory clearances. And now that it is clear and specifically to detail, I think the boost will happen from here on.
All right. And Anand, are there any areas of concerns, for lenders like you, for instance, the cap or the fact that only corporate, just corporate guarantees are not enough, there'll have to be cash, other forms that will have to be considered, by banks when they're looking at FLDGs. Any specific concerns?
No concerns, absolutely. And this is the best model. This is what we were following earlier also. And similar ratios of FLDGs were with our partner banks that we were following. And glad that the regulator has seen this particular ratio as a sane ratio. Otherwise, there was no end to either wave it off to zero or to make it 100%. And with this 5% FLDG, I think it's more about the skin in the game and not really pulling the muscle into the game of the partner entities who work with the regulated entities.
Skin in the game.
And the clear outline is that the regulated entities would be in a better position to do credit decisioning, since they have access to data, access to account aggregator, access to credit bureau, and hence this responsibility resides with the regulated entities itself. Ritu.
Well, more skin in the game, Anand, is definitely welcome. But Ashish, I'm not so sure that that 5% cap is something that won't affect players because, from our understanding, fintechs were offering banks default covers of as much as 100% in certain segments, especially when we talk about unsecured lending. So, according to you, what are the segments that will be most affected and what will be the least affected because of this 5% cap? And will we see some of the co-lending markets see a drop in the near term in volumes because of these new rules?
I don't think there will be any drop in the volumes. Rather, the volume should increase. Like Anand said, 5% is a good enough number in my view. And most of the players who are doing the large scale businesses, 5% of the portfolio is a very decent amount of cover RBI has given. There might be few players who run large risk portfolios. They might need to change their business model. But what in my mind RBI has done here is that by putting a 5%, he brought the skin in the game for the fintech, as well as it has also brought in a discipline for the regulated entities to say that you cannot underwrite the very, very high risky businesses because beyond 5%, the risk belongs to the regulated entities. So in a way, RBI has addressed the consumer protection because they have seen in the past there were cases where there were very, very high interest rates and high defaults has been seen in the portfolios. By putting this 5% cap, we can always argue whether it is 5 or 6 or 7.5, but in my mind 5% is a good enough number to ensure that you build a very healthy portfolios, give money to the right set of consumers over a long period of time, and build a balance sheets both for fintechs as well as for the regulated entities in a right way.
Okay, so you're saying no change is needed in that 5% cover, which is quite contrary to what we've been hearing from other fintechs. Some of them even opine that perhaps 50% is a number RBI could look at. 100% of course would be too extreme. But Anand, coming back to you, now when we're talking about these changes, the cap on FLDG cover, NPA recognition, also the fact that, banks and NBFCs cannot use the invoked FLDG to reduce their provisions. Is this, do you think, to an extent going to dissuade banks and NBFCs from getting into such partnerships?
So the rightful models that were working were around this boundaries only. So I don't think the genuine models would have any impact. And as Ashish rightly highlighted, that the clear impact of a higher FLDG is on the higher interest rate, and which is not consumer friendly. There are models where the FLDG of 20-30% was also available with a 50% interest rate to the consumer. So ultimately, this higher FLDG gets accommodated in the form of interest rate for the consumers. I don't think that is fair. And again, I would reiterate that a market partner for a regulated entity can do only so much of bringing in a particular use case or a user who needs a loan, rather than underwriting the entire credit or taking a decision on that. It is best left to the entities which are licensed to do that and poised to do it in the proper manner.
All right. We're running out of time. Ashish, a quick final question to you. The rules also say that all non-cash forms of FLDG other than bank guarantees have been disallowed. What does this mean for fintechs? Will they need more fundraising to meet these requirements, enter into partnerships?
I think most of the previous arrangements also had a component of cash or a bank guarantee or a fixed deposit. So I don't think there is any change in the environment from that perspective. It actually brings the clarity to the ecosystem, and also to think of a way if there is a person who is not able to put some kind of an FLDG, there are always different ways of building the businesses which they can do it. But this is a right way to bring a very, very cohesive ecosystem where there is a player who has a large amount of capital, which in this case is the banks and the large financial institutions. And there are fintech players who are building innovation to the ecosystem by reaching out to the next layer of consumers, by reaching out to the consumers which today are underserved or unserved. I think it's a win-win situation. I expect three things to happen here. The first is the cost of borrowing should go down for the end consumer. Second is that it will bring larger liquidity to the system, because now more banks and the larger capital provider would be more than willing to partner with the NBFC fintechs, and the fintech ecosystem shall actually attract more investments from the investors also, as well as more innovation shall happen. So it is overall, I think it's a very, very smart move by RBI to bring more inclusion, more customer protection, and ensuring that the delivery of credit is at reasonable price.